Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. Today I'm joined by Michael Ealy, president of Nassau Investments. Mike, it's great to see you. Great to meet you today. Thanks for hopping on with me. How are you?
I'm great, Jimmy. Thanks for having me, brother. It's been great to be here, man.
Absolutely, Mike. Great to have you here. Always good to meet somebody else in the land of Opportunity Zones, doing some Opportunity Zone development deals. You're a new contact of mine. I'm literally just meeting you today for the first time as of a few minutes ago.
Yeah.
Some of my audience might be familiar with you and Nassau Investments and some of the projects that you have underway. But for those of us in our audience of high net worth investors, family offices, advisors, everybody plugged into the Opportunity DB network who may be unfamiliar with you, Mike, can you give us a little background on who you are, where you came from, your background, and Nassau Investments?
Yeah, so Mike Ealy out of Cincinnati. We've done over $300 million in assets, inclusive of apartments, hotels, warehouse, land. Um, and now we're working on this deal in Sarasota, which is a ground up construction over 120 million, which is in an opportunity zone. And it's funny, lately, a lot of projects that I've had are in these opportunity zones. So we're just leveraging those. But for me, it wasn't always like that. Um, when I first started in real estate, I failed miserably, but I like to say failure is nothing but a pile of mistakes that we stand on. And through those mistakes, I learned the what things not to do. As so many people say, did you fail a lot? And I just said, no, I really just found 10,000 ways of how not to do it. And so we're working on this wonderful project down in Sarasota, and then we potentially have another one with land we have here in Uptown Cincinnati, where we can do some affordable housing as well.
Very good. You learn on the job by doing, right? You got to get your 10,000 hours under your belt. There's only so much you can learn from
Yeah,
reading a bunch of
sometimes
books.
I wish we could avoid the 10,000 hours.
It's unavoidable. In
Yeah.
my experience, that's what I've come to learn. At least the books can teach you a lot, videos can teach you a lot, but you got to just learn by doing sometimes. So, Mike, I want to talk with you about your Opportunity Zone strategy, what you're doing in Sarasota, Florida, in particular. But first, I just wanted to kind of recap
Yeah,
what
please.
Opportunity Zones are
I
for
know
my
because
audience.
everybody would really like to learn about these OZs and what that's really about.
Exactly. So, and for your audience as well, Mike, who may be unfamiliar with Opportunity Zones, essentially it's a tax incentive, a federal tax incentive that was created at the end of 2017. It's a place-based incentive. So there are over 8,700 Opportunity Zones all over the country, set at the census tract level. And if you invest into one or more Opportunity Zone locations, as long as you go through a qualified opportunity fund that complies with the legislation and some of the IRS regulations, as an investor who rolls over a capital gain that you may have triggered from the sale of real estate, sale of stock, sale of privately held business, any type of capital gain, take that capital gain within 180 days, roll it over into a qualified opportunity fund, you get the following benefits. One, you get to defer recognition of that capital gain until December 31 of 2026, essentially an interest-free loan from Uncle Sam, so no tax bill due until April 15th of 2027. You'll sometimes hear people refer to the 26 date or sometimes to the 27 date when the
Uh-huh.
actual tax bill is due, right? Secondly, you get to, as long as you hold that qualified opportunity fund investment that invests in assets within these 8,700 plus opportunity zones all over the country, as long as you hold it for at least 10 years, you get to exit that investment completely tax free. So if you have a $1
Ooh.
million gain,
Can you say that again?
completely tax free, Mike. Isn't that great? I think it's the greatest tax incentive ever created. It's essentially a unlimited tax-free growth investment
Mhm.
vehicle. It's akin to a super Roth IRA. So I'll
Yeah.
give you an example. If you invest $1 million into an opportunity zone fund, let's say at 2.5x's over 10 years, so
Right.
you come out with $2.5 million, right?
Yeah,
That's a $1.5 million capital gain that you would
that's right.
normally owe a whole bunch of money to Uncle Sam,
Yeah,
right?
what is that, 30, 45%?
It's a yeah, something somewhere in
Well,
that
I mean, it
range. It could
depends on
be.
what it is. Like, yeah, but still,
Could depend on your state rate as well. Many
yes,
of the states around the country also comply with the program, right? But you can avoid yourself a six-figure tax bill at least in,
that's
in
right.
in this
Absolutely.
example. By the way, one bonus that also gets passed along to investors is that if it's a real estate project in particular, and the real estate project takes depreciation, normally
Mm,
at the end of a holding period, after you've taken depreciation for 10 plus years on any sort of real estate investment, the IRS will tax you on depreciation recapture. Like
that's
all that
right. That
depreciation you
recapture.
took, eventually that tax bill comes home to roost. With an opportunity zone investment, however, there is no depreciation recaptures. You can take that depreciation all along the way. And in fact, right now, under the Tax Cuts and Jobs Act, there's some
Oh
bonus
my gosh.
depreciation. We won't get into the specifics of that. But you can depreciate, you essentially depreciate that asset on a accelerated schedule, and
I was just
really
going to
reduce your
say that.
income.
Like, can you just imagine you do a cost seg, you accelerate it,
Yep.
and you take it five, seven. Oh my gosh, this is beautiful.
It is. It absolutely is. So we did an episode on cost segregation, bonus accelerated depreciation. I did that with the folks over at Plant Moran, Jeremy Samples and Valerie Grundusky, a little while back. I think it was, I don't know, at least 6 or 12 months ago. I'll link to it in the show notes
Yeah,
for
it's
this
huge.
episode. We won't get into the details there, but suffice it to say, it can really help reduce your tax bill even further. And there's no depreciation recapture when you do go to sell. If you're a real estate investor, you probably have heard
Oh
that
my
term
God.
depreciation recapture before. But if it's new to you, just suffice it to say, it's yet another huge bonus savings on your taxes. So, Mike, that's a little bit about opportunity zones. I told you I'd give you my 60-second elevator pitch. I think it was probably more like 4 or 5 minutes.
That's what.
But
Just one more. Why do you think people, and I know you're supposed to be interviewing me, but why
that's
do
all
you
right.
think they like this over 1031? Like, what's better, or what are some of the benefits versus the 1031 versus the opportunity zone?
Well, there's a lot of similarities. Obviously, it's both are great capital gains deferral mechanisms, but there's a couple of key differences. One is, and this actually is in favor of the 1031 exchange, so I'll kind of do the
Okay.
reverse answer to your question. The 1031 exchange, in some ways, is more flexible because it's not place based. You can invest
Yes.
anywhere. You're not locked into these 8,700 plus census tracts. Whereas an opportunity zone, you have to invest in one of these locations, right? Okay, so that's one of the downsides. But the benefits are to capture the full benefit of the 1031 exchange, you have to wait until you die. Essentially, the full benefit is for your heirs. Upon death is when your investment gets stepped up to fair market value, right? With an
Mhm.
opportunity zone investment, you don't have to pass away. You just have to wait that 10-year period.
That's right.
So that's one huge benefit.
That's
Another
huge.
benefit is, frankly, it's just a little bit easier to do, especially if you just want to be a passive LP investor. You just accrue your gain, and then you write a check to a qualified opportunity fund manager, and you really don't have to think about much for the next 10 plus years. There's one additional form you have to file with your tax return. Just pass it on to your CPA. They'll handle that. Whereas with a 1031, you have to jump through some hoops. You have to work with a qualified intermediary. There's a certain time frame for identifying, one or two or three different properties. The transaction up front is a little bit clunkier and more burdensome, I think, for the investor.
Yeah.
By the way, another key difference is, and this one is really important to understand, a qualified opportunity fund investment has a special place along the risk return spectrum. It is a riskier type of investment that is going to typically produce or expect to produce a higher return. And what do I mean by that? Well, in order to be an opportunity zone fund, in order
Yes.
to be a qualifying investment, it has to be either substantial improvement, so very heavy
Mhm.
value add, or ground up construction. And that does just incur more risk. A 1031 exchange, typically you're exchanging into a property that may not need as much work. Maybe it's already
That's
cash
right.
flowing, right? So that's another distinct
Existing.
difference there.
Yeah. Uh-huh. No, that's
So,
perfect.
Mike, I'm curious, and we've gone through kind of the pros
Okay.
and
Yeah.
cons of OZs. We've gone through the basics. What drew you to opportunity zones in the first place?
No, I mean, quite frankly, the word says it all. It was an opportunity.
Mm-hmm.
But let's say the key thing is I provide a service. Yes, I love real estate. I love deals. But overall, I'm providing a service. I'm helping investors get to their investment destination, and it just so, I act as a bridge, and it just so happens I have multiple vehicles. And that's like coaching, apartments, and hotels. And so we saw an asset that would be beneficial for our investors or any particular investors. I mean, it's in the Sun Belt. It takes up, where 50% of the population is down in the Sun Belt. It's growing. It's a very strong market. It's a destination area. And they provide, high returns. And so we saw this project, said, let's go for it. But one of the things in our due diligence we found that was the opportunity zone, and all these things that you shared. I mean, people will hold it. We'll do cost tag. We'll do accelerated, and these people can stay in these deals. This is an asset. We'll call a trophy asset that you really don't want to sell. So this would be an ideal a property where people can wipe out their capital gains, hold a class A asset in prime downtown Sarasota, which this project, you can see the bay where as soon as you walk out, you're literally in the life of downtown Sarasota with the restaurants and pedestrians and business. And so, that's why we went it. And, it's great returns. And so we really felt that and not only that, it's a transformation project for Sarasota. Literally, it'll be a connector for continuing downtown to further out of that neighborhood. So, you know, I just really, really believed in this project, and I knew it would be great returns. And you know, it's kind of hard to do. I know maybe pushing it a little bit, but it reminds me of owning sports teams, right? You remember when like sports teams get in and they bought the sports team for 100 million, 200 million, and now it's worth $1 billion plus. Now I'm not saying this hotel and building's going to be, but I see projections like that for a project because of the area and the growth and how Sarasota's grown and how people are flocking to the Florida area.
No, it sounds, you make it sound incredible. I want to dig in there a little bit more in a minute. Hoping we can kind of back up, zoom out a little bit. I want to hear a little bit more about Nassau Investments, and in particular,
Absolutely.
what's your overall investment thesis? What's your strategy? Where are you building? You have a portfolio of hotels already. Can you tell our audience what you've already developed or what's in the works? Give us a little sneak peek at your portfolio of hotels already.
Yeah, so we've I bought some hotels during COVID. So overall, I'm a value add guy. You know, because look, I shared earlier I failed, and that's because I was over leveraged. I paid uh kind of at retail. And I was in an area where we didn't have high appreciation. In Ohio, it's kind of last place everybody goes. Like Mark Twain always said, look, when the world ends, I'm moving to Ohio because I already know what's going to happen there, right? And so I liked, I like to get deals where we can create value, right? I don't want to get a marginal deal because that's what hurt me back, 20 years ago. And so, no matter what I want to do, we want to force depreciation, whether that's pushing rents up or creating more revenue for the hotel. And if we can do some construction to push the values up, that's what we want to do. I'm not the guy that wants to get into a turnkey a vehicle asset and hope that it appreciates over time. Because, like California, New York, those places can do that, but you got low margins. And then if we go through a market shift where they get crushed. Well, when I do deals, we go through a market shift. Yeah, I'm upset, but I'm not mad because we had so much loan to value. Like, let's say a small deal of 10 million, and we bought it for 6 million, 7 million. And so when the market changed, if we can't get 10 million, I think we're going to be okay at 8. So that's why we like to do deals like this with a lot of margins or where we can create it. And so I've done that through multifamilies, uh, where we did numerous deals where we would buy in kind of low income areas and literally we come revamped. And I will say, we were able to catch the wave. Like when a lot of people were losing things during the Great Recession, I
Mm.
started buying, and we watched the wave. We saw rents literally jump from $300 in the last, those 5, 6 years to $900 to 1,000. And so that's how we won. And we were in these for I mean, I know these are crazy numbers, but literally we were buying stuff for 4,000, 13, 20,000, 20,000 a door, being all in for 25 and then selling for 60 and 70 a door. So we had a lot of great wins. And so uh, we wanted to accelerate, and that's how we got into hotels. And we're kind of coming through at the end of our first cycle of these set of hotels as well.
No, that's great. You bought at the bottom of the market those residential doors. Probably what were you buying those in probably '09 or 10?
Absolutely. So I've always been buying single families.
Okay. Oh, okay.
But then it was fortunate there was a company here. They were called the Model Group, which is now I forgot brick something. But they had the one of the largest portfolios of low income housing. So I ended up working with them as a realtor slash broker, and I got to see the back of the office,
Hmm.
back of the house. And I saw all the developments they were doing. I saw how they did the low income tax credits. And from them, they gave me an opportunity. They gave me my first 28 unit deal that was a low income tax credit. And I knocked it out of the park. And that was the beginning of me kind of being in these low income areas and learning how to manage.
So you bought at the bottom. That's good context. You bought at the bottom of the market, those single families, and then fast forward 10 years later, you see what's going on with hotels. Hotels are getting killed because they have to shut down during COVID. Is that when you started buying up hotels? About 2020 or 21?
Yeah, so yeah, I think Courtyard was the first one.
Okay,
Um, and uh, I said I had this goal I was gonna buy a whole bunch, but we ended up only buying 4. I like to create BHAGs, big, hairy, audacious goals.
sure.
And we were saying we're gonna buy 100 units, 100 hotels, and we only got 4. So I don't know if that was a failure, but I like that failure.
Hey,
I
four is
can
better
live.
than zero. You
Yeah.
did something, right?
So and so when we got that, I will say going through that cycle, I really, really like extended stay hotels. That kind of matches my personality. It matches my thought process because, extended stay is basically an apartment that you can rent, just a smaller footprint.
Sure.
And man, I've learned, really understood the sales on how to put heads in the beds and connecting with a lot of economic drivers in the neighborhood. And so because of that, we've been able to really, create a lot of revenue and occupancy for those deals. And so, we're starting to get offers unsolicited. So I'm like, you know what? Let's have at it.
You're
Move
doing
on to
something right. It
the
sounds like no. So you buy a couple good things you're doing. You're buying at the bottom of the market for these different sectors, and then you're also, I guess, you're buying assets that are a little bit worn, need a little bit of work. So you're cleaning them up, maybe a fresh coat of paint, new carpets, the like, and then you're able to increase the rent or the daily rate in the case of the hotels.
Absolutely.
Is that pretty much
Nothing.
it? Is that the gist of
Yeah,
it?
nothing different than buying an apartment. I mean, an apartment, you want to push the rent up. Well, how you gonna do it? You're gonna renovate it. You're gonna put new carpet, flooring, kitchen. With hotels, same thing. Now, fortunately, if not, you may be doing a heavy lift or a light lift because they have what they call soft goods and the hard goods, right? So soft goods, when you got to do a PIP, a renovation, property improvement, uh, that's typically when you're just replacing the blinds, the shades, the linen, carpet, things like that. But if you
Mm,
got the harder one, the bigger one, that's when you go into case goods like headboards, desk, chairs, things like that. So, ideally, if when we get into another deal besides Sarasota, I would like to do soft renovations. I think that's okay. I did a very labor intensive one with the courtyard. We got it done. I won't say it was fun, uh, but it's done. And yeah, I kind of like those lighter lifts.
sure. Who doesn't, right?
Yeah,
Well, now Sarasota though, that's a different beast because this is not a value add strategy. This is a ground up construction. This is a little
absolutely.
bit of a new type of project for you, if I'm not mistaken. You touched on why you like this project, why you like the location in Sarasota. What more can you tell us about it, and how different is it doing ground up construction versus value add?
Ground up construction is much more challenging. It's a financial commitment. It's a time commitment. I mean, you know, before you even break ground, we potentially have, I don't know, 2, 3 years of pre-construction for a project of this size. I think if we start looking at this project in 20, you know, you know, 2020, 21, somewhere around there. I didn't
Mm-hmm.
close on the land till 22. And then we closed on our entitlements, finalized that in spring of 23, like kind of at the end of January 22 and in 2023. So, it is time consuming. And it's a lot of parties, it's a lot of pieces that go with this. But we have an amazing team. I got my partner Rodrigo. He's from Bolivia. He's developed over 18 towers in Bolivia, and he moved to the States, and we got together. We got Cash Construction, which is one of the largest construction companies down in Florida, like over 8,000 apartment units and hotel keys each. uh, we got Hoyt Architects and Andre Kukowski out of New York, who did the what is that, the I forgot the crossings out there. So really, really high level, really skilled teams. Like, it, you know, this is going to change the way people do luxury living in Sarasota. I mean, it is truly a transformation. Every space was created to fulfill people's desires. Like I say, like this is a place of opulence, and it's going to be an amazing project. And we've been selling condos. We already sold 6 of them, and now we're going into our main season. So, we can look at potentially breaking ground. We could be ready to break ground here in March, April. But I think we're going to wait just a little bit for more sales, and interest rates are going to be dropping as well. So we want to take advantage of that as well. So,
Sure. Well, you mentioned interest rates. That was leads me to my next question, which is, what have been some of the biggest challenges of raising capital for this investment, for actually getting it started, and has the current interest rate climate caused you to pump the brakes at all? We had
yeah,
a
no, yeah.
unprecedented rise in interest rates over the last 18 months. How has that impacted you guys?
So when we first started, it was before all this, like interest rates were like 4, even 2%. So when
Yeah,
we started the
I
project,
remember.
yeah, not a problem.
Not a problem at all.
Um, but then, I started noticing it was in 23. We're just kind of looking around. I saw equity groups just literally jump up. Like I had people like, okay, I'll give you some money. And but instead of that 8, 9%, they jumped to 12 and 13. I was like, whoa, what are you doing? I said, okay, I can do that here or as mez or something. And those are ways to work it, but and we had such great margins on the deal. It can work if we have to. But that's one of the things where we like, you know what, let's kind of pump the brakes. And the reason for that is we pump the brakes, like we continue and wait for the rates to drop. Now I don't think we're going to get a substantial drop, but we'll get a nice drop. And two things happens there. Um, One, by waiting for rates to drop, instead of spending that on interest, that comes back to us. So that's more profit. And then on top of that, we'll have more condo sales. And because of our condo sales, that goes in deposits. And in Florida, we are allowed to leverage those deposits
Hmm.
to do the construction. So guess what? Instead of going out and raising more capital, I wouldn't necessarily call it free, but we got capital that we don't have to pay interest on, right? We don't have to capital that we have to pay debt on. So that makes that project even more profitable. So, those are kind of the things that we're working on and to really have success in this project.
That's interesting. You've been mentioning the condos. What's the breakdown for this hotel? Some of it's permanent residences, condos. It's part condo, part hotel tower. Is that right? What's the breakdown though?
Yeah. So we got, let's see, 35 condos, 120 key hotel, 4,500 square feet of retail. We're going to have a high-end luxury kitchen with a branded chef and a parking garage right in the midst of that. So it actually kind of three sections of this. So you have the condo component. Well, start off the retail, garage in the middle, hotel here, and then condo on top.
All right, awesome. Well, if you're if you're watching us on YouTube, you can see that next to Michael, he's got framed "From Broke to Millions." Michael, you're the author of that book, "From Broke to Millions." Can you tell me and my audience a little bit about it and where we can go to get the book?
Yeah, so you can get the book. You go to from broke to millions.com, but literally I detailed uh my story, how I went from broke to millions. I started off with a two family, and literally I didn't have any money. I had bad credit, and I learned these techniques on how to do no money down deals. And I bought that, and I was living rent free. Now people today call that house hacking. So back then I just said I'm living free. And so from there I started acquiring more real estate, but I was using these techniques where I over leveraged. So I lost everything like 3 years later. Literally everything was in foreclosure. And then, but my god sister, I'll never forget, I was ashamed, I was embarrassed, but she showed me these techniques where I could do short sales. And from that, when I lost everything, I detailed the story. I become homeless, but I then used these same techniques to help build my wealth to over $1 million in like 5 years or less. So literally, I went from homeless to millions, and I share with people how I was able to do that, how I raised money, how the good in the deal, the bad in the deal, how to raise capital, how to analyze the deal. And we really educate people, because what I really want people to do is find success in whatever they do. Because when I started, there really wasn't any groups. There wasn't podcasts like this. The only way you got on the show is if you paid a lot of money or you got on a major production, and nobody can hear everybody's voice, and everybody truly has a story to share that can uplift somebody and take them to another level. And so I just wanted a way that I could share information with people so that they could grow and that they can obtain just a dream, whether they want to acquire 2 units or 1,000 units. I wanted them to know that it was possible for them.
So, who's the book for? Who should get it, and how can they get it?
Yeah, so go to FromBrokeToMillions.com, whether you're a beginner or experienced, whether you want 2 units to live free or 1,000 units. This book is for you. and it will help you take you to the next level. Multiple people that read this book. I got one of the students, Tim Vest. I mean, literally, he went from the C-suite. He left his job. We had multiple people leave their job. Matter of fact, he left his job. He was not doing well in other projects. We shared him these systems, and now he owns over 1,500 units. He did that in 3 years. We had a what was she? Anesthesiologist, a Riverbank. She left her job, is doing deals from Alaska to all over. We got people in Canada. Literally, he went through a divorce, lost everything. Now he's got over 600 units. So, we're helping people all over from not just in the US, but in other countries as well.
Awesome. That's inspiring, Mike. And congrats on the book. And yeah, please do head over to FromBrokeToMillions.com to learn more and to get your copy if you're interested. Mike, just curious, we've been talking about opportunity zones throughout the course of today's episode. Just wanted to step back and
Yeah.
ask you a really high level question. What broader trends do you have your eye on with regards to opportunity zones, or in particular opportunity zone development deals?
Yeah. I'm just really sitting back. It's just, I wish I could say I had this big thing about OZs on, and I really didn't. It's just something that kind of fell in my lap.
Hmm.
It was just opportunity. I just happened to acquire the right pieces of property, and not even looking for it. Like, I just knew these areas were areas that was going to be redeveloped, and so I bought it. People were losing some of their property, so I bought it. And now in those areas, like the one in Uptown, they're redeveloping that whole strip. Like the university and the hospital are putting literally $1 billion on the street of development, and I'm right next to it. And I'm like, well, why not? Well, but I was like, hey, how can we really benefit where everybody wins? And they said, hey, if you do some affordable housing, we'll give you some grant money. I was like, well, that makes it pretty fun.
Yeah.
And then we'll also help you with a line of credit because we need affordable housing. And then they said, and by the way, we're in an opportunity zone. I was like, well, what else? What else is there to go? So people can, we helping people. We're putting people in homes. We're getting enough subsidies to help. And then and investors benefit all the way. Like, now that's a service that I love doing, and we'll be doing the same thing in Sarasota. I mean, we leverage this opportunity zone. Multiple people will be employed. Investors are winning, and we're creating multiple stories that help not just transform financially and architecturally, but spiritually and for families and people in the community.
Oh, that's great, Mike. I agree. Opportunity Zone's doing a lot of great work, and one other thing you pointed out that I kind of caught on to was it's possible to stack a lot of different types of equity and tax credit and subsidies within opportunity zones. Oftentimes, so if you're a developer, or you're a fund manager, and you're trying to get something done with opportunity zones, also look at those other different types of subsidies, affordable housing or historic
Absolutely.
tax credits or local tax
Yeah,
abatements, local subsidies, different types of
absolutely.
grants. There's all sorts of ways to get your projects
I don't think you missed
capitalized.
anything yet, man.
Absolutely, absolutely. Mike, this has been great. Really appreciate you joining me today. If anyone on if any member of our audience, high net worth investors or advisors, want to get in touch with you to learn more about your Sarasota project or anything else you got going on at Nassau Investments, where can they go to learn more?
Yeah, you can go to Nassau Invest. That's www.nassau invests.com. You can go there, or you can just finally go to LinkedIn. You can go to LinkedIn and find me there as well. Mike Ealy, or it's under Michael Ealy under LinkedIn. I'm out of Cincinnati, Ohio, and but there's my website as well, posted there. So If you're interested in joining our investment group, hey, just click on the link and sign into the portal. Or if you just want to get some education, we got plenty of training. Whether you want to be an active or passive investor, we're here to assist you. Just like Jimmy, you are as well. I mean, this is an amazing program that you have and sharing all about these opportunities on. So I thank you and applaud you for everything that you've been doing.
Awesome. Thanks for the kind words. And thank you, Mike, for joining us today. As always, we'll have show notes for today's episode. If you want to view those show notes, we'll have links to all of the resources that Mike and I discussed on today's show. Just head on over to opportunitydb.com/podcast. And please be sure to subscribe to us on YouTube or your favorite podcast listening app to always get the latest episodes. Mike, again, it's been a pleasure. Thanks so much for joining me today.
Thank you so much. Peace.